October's market drop breaks a historic streak and puts investors on edge. The catalyst shifts from vague risk to real-world tariff shocks. How should you play it? Keep your equity position and lean into bonds because the next move could surprise everyone.
19 trading days in a row without a 3% pullback on the S&P 500. And that's the seventh longest streak without that kind of a pullback historically, going all the way back to the 1950s. And when you look at those streaks, we've returned like 28% before today. And that's the strongest performance we've seen within any of those streaks. So when I think about it, this is just, I think, a needed correction and a needed pullback, something we've been waiting for. Sentiment's been extreme. Talks of bubbles, talks of doubling between now and March of next year, and analogs to 1999. This is healthy. We're in this window where you'd expect it in October, and that's how we're approaching it as of now, as a healthy pullback.
But I mean, sometimes you look at these things and it sounds like this is what you're suggesting is we were overbought, we were due for a pullback, and now we're getting it. And sometimes you can't point to an actual catalyst that would send you into that sort of atmosphere in the market, whereas the difference today is we have a serious catalyst, and it's a renewal of tensions between the United States and China. We're talking about the possibility of more tariffs, not less. The market had sort of been anesthetized to the whole issue because we haven't really talked about it all that much, and it figured this too shall pass, and we'll get on to talking about rate cuts and positive earnings. But now we have a serious concern to think about, depending on what the president does and if he does it.
Yeah, I mean, it's a concern. I've been a little bit in recent weeks talking to clients and saying, we were so concerned about tariffs, and tariffs are a real drag. And we didn't have a full taco from the first round of tariffs, really. And so we've expected somewhat of a fiscal drag. Our recommendation for clients is to keep a full equity position and then have an overweight bond position, and in fact have skewed towards a little bit of duration. And you can see it on a day like this, because I think that if we're gonna have another flare up in these tariff negotiations or some kind of trade war, I think that bonds will end up being the place that you want to be, because it's going to manifest itself as a growth scare. So that's been the way we're playing it. I think we've gone through this, and ultimately we've already tested the limits of what Trump can tolerate. And I don't think I think the taco trade is still with us. Yes, there could be a little bit of danger in saying that. But if we get a little bit more weakness in this October period, I think you'll see a capitulation on his part. And ultimately, we'll get back to where we were, a few weeks ago. And it's just going to be a nice sentiment reset. That's how I'm interpreting it.